this is the DAX. So if you go to dailyfx.com, it's a fantastic site. As the name suggests, it's about FX, which is foreign exchange, currencies. So from there you can get these kind of plots and see what's going on. So we also have plots of, say, the DAX, which is not FX. So you can also look at gold, oil, stock markets. Now the reason I'm doing this is, well, as a quant, you know, we're looking at things from more a mathematical point of view. You know, so we'd model the stock market as a log normal process. You know, we talk about the trend term and the noise. But with our trader hat on, we jump in to the charts. And we have a different language, a different set of tools. So we're talking about the same thing, but we look at it in a different way. So as a trader, I'm looking to make money. I'm not just saying, it's not good enough for me to just say, oh, here's the DAX, which is the German stock market. So you might know the Dow Jones, the S&P, which are American ones, the FTSE for the London, the CAC for the French one. The DAX is the German one. So the first thing is, we love traders, that is, we love charts, because they are representing the raw data. There's no interpretation, model simplifications, because, you know, we were talking about with models, we have to simplify, so there are gaps in the model. We get the main qualitative features, but we have to kind of cut away, remove a lot of detail to be able to see the heart of the matter more clearly, I suppose. So what do I want to say about charts? Well, first of all, just to get you to see a chart. I mean, if you haven't seen charts before, this all looks very alien. So what does this mean? Firstly, these are called candlesticks. They come from Japan. So a green candlestick means that the price went up. Red means it went down. So the bottom is what the price was at the beginning of the day, because this is 1D, a daily plot. And the top of the green bar is where the price closed. These narrow wicks are where the price went to during the day, but fell back from. So have an example. Say this one. So here, the price fell down to that much sometime during the day, but then it fell back. So in fact, since this is a green candle, it began here, there was probably some news, the markets kept going down because the previous ones had been red, 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 but then it turned around and went up. At some point it went slightly higher, but it fell back to the top of the green bar. So these bars capture a lot of information, and they've basically been found to be convenient. So I want to there's so much you can talk about, but I want to keep it brief. This is an introduction. So why am I talking about the DAX? Well, basically because I'm really happy, because I bought it right at the bottom. I think I bought it, well, 107.20, something like that. And it's just shot up. So you could say, good luck. But why did it do it? Well, using these charts. So, firstly, I want to add some structure. So this in itself is very handy. You know, I can see, okay, basically the market seems to be going down. One of the things you look for is this wave. This went down. It tried to go up, but didn't manage to break to a new high. So then it fell back down. So we got a lower low and a lower high. See, it was high up here. It broke, went down here, tried to go up, only made it halfway before falling. Then it went, okay, it's fallen a fair bit. It tried to go, tested on the upside again, but again it failed to hit a new high. When it turned around, it was able to make a new low. So here we see lower highs and lower lows. So we have a downtrend. Then you go, well, why did I buy here? Well, the pattern seems to be, at worst, it will fail, or the basic trend seems to be that it's going to not make a higher high. So it'll stop about here. But I don't believe that. I believe it's going to go up a lot. So that's what the rest of this lesson is going to be about. And I add that I don't know that it's going to go up a lot. I don't have magical information. I only have these charts. But why do I feel that the chances are it will go up? So I'll add a bit more structure, and I'll explain what they are. Then I'll show you why I decided to do the trade I did, and then we'll see how it works out. Okay, so I like 50-day and 200-day. Now you could have 60, but it's that kind of length. Okay, so now what do I want to do? So I'll explain what I did. I added the Bullinger Bounce. So what they do, they plot the 20-day moving average. That's that brown line. The 20-day moving average is, it looks at the last 20 days prices and gets the average. So it will move up and down with the shares, but it's averaged. So that's the brown line. I'll zoom back a bit so you can, I think that will help. Okay, so you can see the brown line has acted as a support along this whole period. The market's moving up and down above and below the average, but when it's in an uptrend, it seems to bounce along the 20-day. So what are these light blue lines? Well, the Bollinger Band works out the average for the last 20 days and also the standard deviation. So this area, the brown line is the 20-day moving average, and these lines are plus or minus 2 standard deviations. So essentially, if the price is like normally distributed, it should remain within 2 standard deviations I think 96% of the time. So from just random movements, as the markets drift up and down, it should remain within, bounded by these two lines, so, which you can use, for example, when you're placing your stop losses, so that if the price jumps up and crosses this, then I get out because the market's going the wrong way for me. So that's the Bollinger Band. The 50 and 200-day moving average are exactly that, just the moving averages. So it'll take the average over the last 50 days or the average over the last 200 days. And they're particularly used. They're not just, oh, I'll just take whatever average I want. The 200 is seen as the line. If the market is above the 200-day moving average, then we're in a bull market. You know, the world is feeling good. It thinks the market is going to go up and up, and money flows in, which is the case most of the time. If it breaks the 200-day moving average, if it breaks below the 200-day moving average, then it's a bull market. It's a crash. Things are bad. You could also use if the market falls by 20% from its top as the key level, because I mean that is another key level. It's rare the market falls more than 20%. If it does, then things are bad. Finally, we have the RSI. That's just a technical indicator, which is frequently used. It's available in most plotting places. So there, it just looks at how the share or the thing you're looking at, so in this case the DAX, is behaving. And if people are buying and buying and buying, this goes up and up and up. So this is very simple to explain. It's a sentiment indicator. If it crosses above 70, you would call it overbought. That it needs to cool down a bit. It's also a sign that in general the market is bullish on this, that people are buying and buying. So the key level is whether it's 70 or above, or whether it's 40 or below, or maybe 30 or below. It depends on the thing you're looking at. So it's just a convenient, or it's a handy indicator, and one I like to be aware of. So essentially, say you have a share and you go, oh, I love this share, it's great, it's going to go up and up and up. Ideally, what you want to do is buy that share when the RSI is down at 40. Now that might seem crazy at the time you're looking at it today, but if you look at your charts, you can see, well, several times, you know, it happens every other month. So if you buy when the RSI is down at 40, that means that's the time when people are suddenly going, oh, are suddenly very negative about the share. They suddenly feel that the share is useless. There's been some scandal. There's the main rival has come up with something great. So in general, the market is very negative. So there are far more buyers, or far more sellers. And that's when you want to buy it. That's when you're having a fire sale, when the prices are falling and they are delighted for you to take the share away. If you are strategically placed, if you have a list of the companies that you really want to have, and you wait till they're available on sale, you're getting a far better deal. So that's just a quick, messy introduction to a lot of key concepts. The 50-day moving average is the one that typically will hold. So if you're in a bull market, I'd like to change that. I can change the color. How do I do that? Style, I imagine. Click on the color and I'll make that red. Okay, so you see that is rarely broken. So in a bull market, when the shares are going up and up and up, when suddenly people panic, it tends to fall down to maybe the 50. The 50 holds well. You're not going to come down to the 200 unless things are serious. So the 50 is the one I would more regularly use. So the main point, now I've introduced the main components here, and in a way I didn't need them all. But, oh great, it's gone up more, so that's more money for me. So now I'm going to zoom back, which is one of the things with FX. The picture looks very different if you zoom in or if you zoom out. So you want to see it depends on what time scale you're looking at. So here's my time scale. Okay, doesn't have a... Okay, so this is zooming back a lot. That's the point. So what I want to do here is say, look at the blue line, which is the 200-day moving average. And you can see it's rarely broken. Now, the times it has broken, there was the 2001, the dot-com bubble, maybe 2008, 7, 8, I suppose Lehman Brothers, housing for everyone for free, and is it going to be that again now? Only time will tell. But so this trade, buying the DAX yesterday, was based on the fact that it's actually hit the 200-day moving average. So I'll zoom in again, actually, because this is messier. Okay, this is probably about right. So if you go back, we see if it falls down to near the... See, it touched the 200-day here. It touched it here. It touched it here. So they were actually great buying opportunities. In general, if you're near the 200-day, you're getting a fire sale. You're getting to buy the index for dirt cheap. And the reason I'm happier still, and why I'm making this video, is this pattern. That when it falls to the 200-day moving average, and the immediate response is to get these green lines, suddenly the price shoots up. Look how much it goes up. It was down at, say, 7,500. It kept going up till 8,500. So that's like €1,000 if you just bought one. And the way you'd sell is, you see here, the RSI is 33, dirt cheap. Hold on to it until it crosses maybe 70, 75. So you want to be trimming your position once it maybe crosses 70. You have to decide there. Do I want to sell it at 70 or... Okay, for this movement, I could have held on to it till it hit 77, but then, it did fall back down again. But, so my trade is to hold on to it and essentially sell it when it's cross 70, but not immediately at 70, I'll have to decide then. So look at over here. The next time it touched the 200-day moving average, and then whoosh, it's off. So now you could have bought it at 7,700, and then if I'm waiting for to sell it till it hits 70, I would have sold it at 8,700. So again, about €1,000 up. It's nowhere near the 200-day moving average. So if I'd waited till you have to decide when you wanted to sell it there. But it hasn't. Remember, if I'd bought it here, I would have bought it at 7,700. So even with the recent fall, even the dip down here, that's still well above 7,700. So I'm going to have to think about what my exit strategy is. I mean, I'm happy that I bought it. So here again, if I'd bought it when it was near the 200-day moving average, I would have bought it at 9,000. So then I want to sell it at, say, 70. So I'd want to sell it at around about here when it's at 9,700. So maybe €800, €700 profit to be made there. So I think that's at the moment what I'm thinking. You know, buy it at 10,800, sell it at near, looking at the chart, sell it at 12,000. So there's still a lot of money to be made. Of course, if you buy now, your downside is a lot greater. You know, here I bought it and I'd put a stop loss just if it closes below the 200-day moving average. It wasn't a long-term bet. It was a speculative bet. So at the moment, it's all good. The market action, you know, with these strong green signals, strong green candles, it looks like it should be a nice smooth ride up to 12,000. Again, if you buy it now, the risk reward ratio isn't as great, you know. So if it now turns around and falls and ends up below that, you know, what's your exit? If it does start falling and falling, do you sit there going, oh no, it's going to go up? It's a tougher call. I would now kind of happily get out because I've already banked some profit. But I do feel at the moment, you know, again, see here, it fell down to the 200-day moving average and then whoosh, up. And there, so wait, if I sold it, I need to see the RSI. I'll just finish up in a bit now. If I bought it here at the 200-day moving average, the RSI was down to 40. So, you know, it's very bearish. The market was, you know, oh, it's the end of the world. And then if I held it on till 70, I would have sold it at 10,250. So that's 800, 700. In fact, if I just held on to it, it could have gone up a lot. So that's more the decision you have to make. Of course, that's still a lovely profit, but you would have made a lot more if you just held on to it. Actually, I'll finish up on that with this analysis. It might be more clear if I look at the weekly chart. Okay, so from the weekly chart perspective, should I wait till the weekly crosses 70 to be my signal to sell. It's something that I will be doing in the coming week or weeks, since I am at the moment sitting on a winning trade. So then, I'd be kind of kicking myself, going, "Oh, I sold it here and it went up to 15,000, and so if I'd sold it, if I'd bought it, say, here, so at what, 10,800, and I just sold it, really delighted with myself because I made €200, when actually the market just went up and up and up to make a lot." So the other strategy is to buy it and then use the 20-day moving average as your stop loss. So as it goes up and up and up, the 20-day moving average is going up and up and up, and in the end, okay, did that hit the 20-day? I don't know. So that's the kind of thinking you have to do as a trader. And those kind of things, like the RSI, the market being oversold, candlesticks, these patterns, they are not mentioned when you're a quant. As a quant, you just go, "Oh no, this is a normal distribution, and I've done the chi-square test, and it statistically fits it," which is great. But this is the front end where you're actually making the money. Did any of you trade the DAX? My other just general overview thing on this specific trade is that my feeling was that either way it's a win. If things work out, if Greece is kept within the Eurozone, that's great because it's been resolved. If, on the other hand, Greece is kicked out, again, it's been resolved. It's only a couple of % of the Eurozone economy. It doesn't economically matter that much. I would hope that it is kept in politically and so forth. Again, I'm from Ireland, so Ireland also had a bailout, so we know the feeling. So there's also that layer, that feeling that essentially markets do not like uncertainty. If either way a decision is made over the weekend, that reduces uncertainty and risk, and so markets should surge. Buy on the rumor, sell on the fact, or in this case, sell on the rumor, buy on the fact. And on Monday, most likely, I'll be back to my normal quant. So I want to have a combination of looking at markets, talking about quant stuff, which is more mathematical and modeling and that kind of stuff, as well as trading, looking at the markets. So today we're looking at the DAX, but there's also other markets. There's particular shares, there's oil, there's gold, there's an endless amount of stuff. Enjoy the weekend.